Hi everyone, it's Benny the Finance Dog, and welcome to my channel. Today's video is on how to draw supply and demand zones. We'll also review my trade from today afterwards. Let's begin. As a reminder from yesterday, supply and demand zones are areas on a chart where buyers and sellers are likely to come into balance. These zones can be used to identify potential trading opportunities and to manage risk. To draw a supply zone, look for a price level where there has been a significant amount of selling pressure. This can be indicated by a large number of red candles or by a sharp decline in price. I like to think of it as imagining where the majority of people said, let's take some profit here. And in so caused a reversal to the price in general, as sellers now outnumber the buyers. Once you've identified a potential supply zone, draw a horizontal line across the price level or use a rectangle. To draw a demand zone, look for a price level where there is a significant amount of buying pressure. This can be indicated by a large number of green candles or by a sharp rise in price. Similar to supply zones, I like to imagine this is where people say, okay, now is a good time to buy this particular stock and enter into the market. Once you've identified a potential demand zone similar to supply zones, draw a horizontal line or use a rectangle to identify that particular zone. Using SPY and the same charts we went over on Sunday, here's an example of how to draw a particular zone. It's important to remember that supply and demand zones are not perfect. The price of a security may not always respect these zones. However, by identifying supply and demand zones, traders can identify potential trading opportunities and manage their risk. A couple of tips when using supply and demand zones include using multiple time frames, using technical indicators, and of course managing your own risk. We'll go into detail on indicators in next week's videos, but it's important to realize that supply and demand zones alone are not enough confirmation to ensure a guaranteed result. Now, let's go to the charts to review today's trade. As always, we start with the daily chart. Following Monday's massive move to the downside, Tuesday seemed to continue the trend downwards, though buyers pushed back as prices fell below the 179 point. Buyers pushed it back up higher than that. Moving to the 4 and 1 hour charts, we can see that yesterday was pretty range bound, and the pre-market hours didn't really have a direction 100% built out, but 179 seemed to be a ceiling, whereas 178.75 seemed to be a floor. Trade I took today was actually much later in the day, given the fact that I am currently sick, so I didn't really watch the charts for most of the day, and it was a gift of a day. Apple sprang up in the first 30 minutes of trading hours, but then afterwards just had a nice, beautiful downtrend for most of the day that reversed at about 11 o'clock, which is where I entered the trade by buying one June 9th expiration call with a strike price of 177.50 for $152 per contract. I was able to catch the rebound, and this contract went up all the way to $174 per contract, but moved against me and triggered my stop loss at 162 for a $10 gain on this particular trade. I was happy that I was able to call the reversal, and I was playing it pretty tightly given that most of the day's trend had been down. You don't want to step in front of the day's trend too much, but I was able to scalp a quick win, even for being sick, so it was nice. Tomorrow we'll continue our conversation on technical analysis and go over a trade for tomorrow. Please like and subscribe for more content. Woof woof.